Hi, Jacob Field here from Ripehouse Advisory. In this video, we're going to be doing a quick walkthrough about what we're seeing in September, the opportunities, the things that we might need to be looking out for, the suburbs that we are seeing emerging, and exactly where we are buying properties or seeing that opportunity for you to take this away for yourself across Australia right as of now. So we'll be going through all of that research. Before we do though, I wanted to introduce Julian, who's the head of strategy here at Ripehouse Advisory. He's flown down here to Hobart to be in the studio and to talk us through some of what he's seeing at a strategy and a tactical level. Thanks for joining us, Julian.
No worries, Jacob. Good to be here.
And I wanted to draw our attention firstly to this article. I was, sitting there this morning over my cornflakes, and it read 77 lives ruined. Right, that was the headline. They have changed it now. They might have been A/B testing that throughout the day. But the nuts and bolts of this article, as you read it through, you've got this image that really jumps out to you. It's an apartment block. Because it is 3 stories or above, you don't go through the same builder's warranty or insurance processes. So these guys have bought one of 77 apartments. There have been major defects in this block. We've got fire, the fire regulations have changed, but they've had to replace all fire cladding and they've had major waterproofing issues. And because of the height of this block, they're actually not covered in any way through warranties or insurance. So now they've had to pay for it all to be fixed, and their strata levies have gone through the roof. So for many of these people, the strata costs are actually more than their mortgages. Now, the reason why I'm bringing this up, it's not to doom and gloom or to scare. And when we see this, we're going to see a tremendous amount of opportunity, as Julian's going to talk about in a moment, in the market at the moment. Interest rates on pause, a lot of things that we're seeing flow through from America. Tremendous opportunities with the data in different places across the country. This is a time where I've seen investors in the past just be headless chooks. I've got to buy anything. There's opportunity everywhere. Let's go out and acquire properties. Well, we have to take this and we have to remember it, because we can't just buy anything. This is going to be a deeper dive into the types of properties, where to buy them, and potentially some of the research to support that conversation. We need to keep this in the back of our mind. We need to be buying quality assets at all times, not just in a rising market. What do you think about that, Julian?
No, absolutely. I think, what we notice as a business is that 80% of people are trying to do everything at the same time. So we're starting to see confidence come up at the moment, and everybody's thinking, I need to get in before I have a fear of missing out.
Yes.
And when you do that, you expose yourself to risk because you don't follow a nice process. You don't risk mitigate. That's what good investing is along the line. It's risk mitigating. This is a perfect example of not risk mitigating.
Yes.
And you set yourself up for failure, potentially for life, when you get a property like this and you just rush on in.
These guys are stuck. I mean, this is not to sort of scare. I mean, these guys literally can't sell because the strata fees are through the roof. The property's not worth what they paid for it. They have to declare bankruptcy basically to get out of this property. Like that's where they're at. But I mean, at a high level, I think you were having a conversation around mortgages. You're talking with our partner, ALIC from Melbourne, around what they're seeing from the mortgage space. Can you sort of give some observations there about now compared to other times in recent past?
Yeah, absolutely. I mean, we obviously saw interest rate rises go non-stop over the last 12 months or so.
Yes.
And if we kind of zoom back in terms of applications for loans, so these are pre-approvals, some of them to purchase properties, June and July last year compared to June and July this year gone, we've seen 3 times the amount of applications. Wow. So if people out there need a bit of an alarm bell to say, hey, there's a wave of people potentially coming through to property, which we already know listings are very, very short. We're at really record lows for listings.
Yeah, we are.
You're about to start to see potentially 3 times the amount of people applying for these properties as consumer confidence is starting to pick up now that interest rates have gone on pause for, I think it's 4 months out of 6 or something. I think like that.
So that's compared to the 12 months before. So putting that in context, like 12 months ago, we were still in a very bullish state. Interest rates hadn't started to move yet, and we're still now 3 times that level of applications for finance as of July. Right, the horse is bolting. We're not saying this, we have to act with diligence and care, and I think this is breaking down, I think in terms of providing information to make informed decisions, not to tell people what decision they need to make, but this is about high level information, and the application I think is for each person's discretion. But there is a lot of people piling into a lot of markets. We are seeing stories around 150 people on pre-application lists before the first open.
Yep.
But pre public listing, pre-realestate.com. 150 people have basically fished through that property before it's even listed on realestate.com. Markets across like Perth, it's extremely inaccessible in terms of an investment market because of the level of inquiry coming into it. You have, a country focusing in on one city, and then you add to that now 3 times as many investors now picking their head up.
Yep.
And wanting to get involved. And so that's a little bit of context, I think, of where we are now. The one takeaway for me is we can't get thrown around. For me, it's always the good time to buy a good investment property, whether that's doom and gloom or bull.
The best time was 10 years ago, right? That's always the best time was yesterday.
Yeah.
So,
but we don't want this market to fear of missing out throw us around. We've got to act in the same processes and implement it. With that in mind, though, this is what I'd love to cover and get into the nitty-gritty of where we are buying as of moving into September. So this is August data, where we're actually buying. As we know, we take a scientific or a data-driven approach at Ripehouse. Many hundreds of millions of dollars worth of purchases now over 10 years. So this has been beta tested and signed, evolved. It's been many years now of improvement. Last month capital growth result, we generated 4.2% capital growth in 1 month. So the whole algorithm is about front-ended growth. It's about overperformance in the short to mid-term, and then we want to pick an asset that after that 5-year period, it goes back to the average, not below average. We don't want to buy a basket case. We want to buy something that's rock solid long-term, but in the short term, it's front-ended growth. Over the last quarter, we generated 8.3% compared to the overall 7.5% alpha. That's the difference between us and the normal. Emergent LGAs, it hasn't really changed much, but it has concentrated more towards regionals in Queensland and Victoria. WA has started to trickle down. So we've had a higher emergence of Queensland in the last couple of months versus WA. I think that's at a high level, state-by-state comparison. We did have this other chart. So this is where the data is showing to us is really firing on all cylinders. And this was a chart that you pulled up, Julian, which you might like to speak to, which I think is actually purchases or transactions.
Yeah, so this is a good chart in terms of, I guess, without giving our secret sauce and locations away exactly, where we are making a bulk of our purchases at the moment. So we can see we've had a big shift. If we probably went back about 12 months ago, WA would be...
Oh, it's here.
Yeah, it would...
Flipped over.
Flipped over completely.
Yeah.
So, whilst everybody else is kind of fighting over a chip like a seagull at the moment in the WA market, that's not where we want to be. Like, we want to make rational decisions, and we've really kind of started to push more to that Queensland, whether it be even in the capitals, that's picked up. I think they would have been in very low single digits last year.
Yes.
That's picked up.
I'd expect that to continue rising as well.
But probably the big surprising one there is my home state, Victoria. That's quite a bit of acquisitions happening in there.
Yeah. It's interesting. You're right in terms of it has completely flipped. WA and regional Queensland have, WA. It was the vast majority of acquisitions in the last 12 months. Obviously, they've all performed very well. It's no secret that WA has done some great things in the last 12 months. What does that actually look like? Because the data is still looking very strong for short to mid-term performance in WA. Gun to my head, I don't think you're really going to be able to beat WA, Perth over the next 3 years. Potentially Sydney and Brisbane obviously are right there as well. It's hard to pick a winner. So there's a lot of opportunities still in WA, but as mentioned before, you've got seagulls fighting over a chip. 15% of acquisitions, what does that represent as a business? Very comfortable with our acquisition window, but the only deals we're getting done are leveraging extreme points of leverage on a sales agent, or
a lot of pre and off markets are coming through in that Perth market now, where because we can't really deal anything open market because it just blows out 5%, 10% over value, which is not,
it runs away.
We don't want to be in that space.
So we're leveraging all the transactions, I guess, that we've bought previously and our relationships that creates with agents. They know what we're like, etc. We've got that buttons that we can push to then pull in these deals away from the masses so we can actually isolate it to purchase. What was the yield that you had a property that you mentioned that you saw transact over in WA?
Yeah, so that was another off-market actually. So that went through yesterday, unconditional for one of our clients. So it went through at a 7.9% yield, and it might actually be a little bit higher than that with just a couple little tweaks there, which is even in this market, we might even be in cash flow positive territory for the cash flow hunters out there. Yeah,
I guess that's probably, looking back at some of my first investments, so a good cash flow, but it's 3 or now into 4x, like over 20 years, 4x returns. Like that's what sort of made me the money. Like $20, $50 a week. That's great. That's a slab of beer or whatever it is. It's a 4x return on the purchase price. That's what gets you out the back door. Like we are all 100% about capital growth. This is a capital growth conversation, but. A 7.9% yield in a Perth market, there is still opportunity, there is still yield to be had, and I think that supports the depth of this market and the growth cycle over there, where the yields are sitting up. Rents are keeping pace with the capital growth. Like rental growth is keeping pace with price growth, even now. And those people thinking, well, hang on, is the market going to slow down? The first indications I would see that a market might start slowing down would be the rents start pulling back, or not pulling back, they won't drop, but slowing down in comparison to price growth. And then you get the heat moving out of the rental market, which flows onto the buy side. That hasn't started happening really in these key markets in WA. It's just now really in the parabolic growth stage.
And if anything, it's probably the market you're least likely to see it, because it's 0.3% vacancy rates in Perth. So you're talking about one in every 300 odd properties are available for rent.
That's crazy.
That's extreme. That's a whole flock of seagulls fighting over a chip there in terms of in the rental market. So that's going to keep, even if interest rates come down. Just the demand's going to still keep that just powering forward.
And it's I'm just sort of thinking that when I have that sort of floor, it's like, what if it changes? And if it changes, it will change in a big way. But I won't go into it here, but we have talked recently about the Perth market. It is a long-term play there. Like the international migration to the Perth market is extremely strong. People coming through Perth as a first port of call thinking this is nice, let's stay. Like that for me sums it up. It's not just a mining state, but probably just really quickly going through, that's really interesting, Julian, bringing that up, what we're actually doing week to week, because I think this is going to give you a really good indication of some of the due diligence checklists you need to be looking at properties. We can't cut corners here, and particularly in this market. Like when you're having to look at and being thrown around with properties, you can't, close enough is not good enough. Like when we were buying in a rising market, we don't want to be the top of that market. We don't want to buy anything because you have to hold that long term. This is the time to do your due diligence. If a deal doesn't stack up, we move on. So I'll just run through this really quickly. Jump in if I miss anything, Julian. 15,000 suburbs in the country. We only invest in the top 10 percentile in terms of our capital growth score, the highest performing capital growth score in the country. Well and truly now applied over many hundreds of millions of dollars worth of purchases. Of those, I'm personally going in and vetting these. It's something that, I'm leveraging the local knowledge. I'm talking to the guys here in the office. I'm saying yes or no. We don't approve it based on the data. It has to pass the human check. So, it's only about 1 in every 5 of these suburbs from a data perspective gets manually approved. Of those, the current suburb median of those is 500,000, average gross yield of just over 5%. In those suburbs, 252 suburbs, in the last week, 4,801 properties on and off market available to us. We ruled out, 4/5 of those, from that down to that, based on a early first pass over due diligence checklist that the guys upstairs are doing. You need to be doing these on all properties. Is there high supply or new construction in the immediate area that's impacting this and the immediate catchment area? Is this a low demand property configuration? That's not rocket science. Don't buy a white elephant. Right.
Don't buy the ugly duckling on the street. That's what you want. You want something that everybody's going to want to buy or rent in the future, because if you ever decide to sell that property or you want to rent that property out, it's a no-brainer. Again, seagulls over the chip. That's what you want for your property. You want
on the exit. Yep. And that's just about buying what the market is demanding and not trying to, if you can't afford a 3-bedroom in the suburb, don't buy a 2-bedroom because that's all you can afford.
Yep.
People are demanding 3-bedders. That's all we're focusing on, right? So we're ruling a lot of properties out there, incorrect bedroom configurations, floor sizes, suboptimum land size for the area, too big, too small blocks, price outside core demand, the edge cases, high public housing. So we're ruling out a lot there. We're then getting down to 252 from 975 based on our street level. So low public housing, good owner-occupier levels, lots of houses, if the street's demanding houses, good rents and good yields, right? So Ripehouse sweet spot, it's amplifying our capital growth results at the street level. From there, we're getting down to 92, and we're doing a second pass. So we've called 252 agents for the week, and this is the last week rolling. This data is directly in from our systems that track all of this. 252 calls. We spoke to 252 agents, 113 after the agent conversation we rejected. Agent said, sorry, just sold it. Bikie hang out next door. We don't deal with interstate people or local people. We don't deal with locals. With whatever it is. There's a raft of reasons. I've had some very funny conversations with agents in my time. Public housing, pools, land shapes on main roads, overlays. These are some of the common gotchas, I guess, Julian, Absolutely. That we see with.
And I think people really undervalue picking the right street. When I take clients through a demonstration, we pull them up street by street analysis, and I deliberately pick areas that are 30 or 40 years old.
Yes.
They get to see, I guess, the time play out. So you can get an estate where all the homes are basically built around the same price, maybe $5,000 or $10,000 difference here or there.
Yes.
You fast forward 30, 40 years where you've seen where the bad streets are and the best streets are. All of a sudden you've got a pocket that's worth $1 million and you've got your other pocket that's worth $600,000 or $700,000.
So isn't it?
You can't
That's
underestimate.
And that's like that would have been a new estate, a housing estate 30 years ago. We're not going to go into a new housing estate here, but maybe those areas that are 5 or 10 years old. I mean, that's the bread and butter of what we look at. Good quality, established. No new homes can be built. And then getting those right streets. It's actually 20% plus or minus is the difference. So if the suburb goes up 10%, you would expect sort of 8 to 12% based on the street levels. And then think of it simply, you're a local where you live, you know the area. If you had a friend or family coming from interstate to move into your suburb, you know exactly where they should go and buy.
Yeah.
Don't go down that end of the street, stay up here. That's the sort of information you need.
It's not only just the capital growth that people often forget. You'll see huge rental discrepancies from a small pocket, which is a couple minutes drive from one another.
Yes.
Where it could be an extra $100, $150 a week. What you're going to find when you get those pockets is those cheaper parts, less desirable.
Yes.
Your tenant's going to be there 12 months, 24 months. They're going to not be happy with the area. They don't like leaving their kids out to go play in the street. They're constantly
leapfrogging.
Those better streets, you could get somebody that's either zoned there because there's a school nearby or their friends and family. They could stay for 5, 6, 7, 10 years. It's the perfect tenant you want to attract. Working professionals, working families. So that, in terms of, this is one of the best risk mitigations that you can actually do in terms of, because I know that's a huge concern when I speak to people every day is, I'm really worried about the type of tenant that I'm going to bring.
Yeah, these are the sort of things that you're doing. That's the local area, I guess, mindset and due diligence you need to do, that's for sure. Really quickly, we'll run through this. So 92 properties passed this due diligence checklist. Okay, this is in a week. 62 after a formal valuation, stacked up from what we think we can buy it versus what we think it's worth through a negotiation period. So we rejected another 1/3 of properties there because we just didn't have any meat in the deal. 62, we'd gone through that valuation process. We actually went ahead, presented 56 properties, and we had 22 offers made on those. So we're very fussy. So we've gone from 4,800 properties down to 22 offers made. That's like a 1 in 200 drop-off.
Yep.
That's the process you need to go through, even when the market is 3 times as many finance approvals. I think that's the important point. Any final thoughts on that, guys? Any feedback from the audience, but any final thoughts from you, Julian?
No, I think it's just really important now where we're going into a period where it's going to get silly out there. It's potentially, I think we'll probably see the height of the silliness come probably next spring, next summer. This is just probably the start.
It'll slow down again going into Christmas and the New Year.
Yeah, always slows down. All the agents
I
go
think
on
October,
holidays.
November could get quite sort of frantic, but then it will sort of pull off a little bit.
Yeah,
so.
But then you might see spring, October next year where it'll be my kind of predictions, and we might see another 2021 kind of period where everybody's just hundreds of people are lining up the door. There's a queue to even buy a property. It's just crazy.
As soon as there's a little hint of consumer confidence, which we're already there, you've got no new houses being constructed, or very low. Yep. No hope for that to change.
Not at all.
And record low vacancy rates. That hasn't changed from 12 months ago. So you're just straight back to the same conditions that we were when you had the strong capital growth. So.
And then you've also got, people don't want to go out and rush, and they're not going to see as many first home buyers walking through new home estates now where they're worried about their builder collapsing or
True.
If it's going to take 2 to 3 years for their home to complete. They're going to be darting back, looking at established properties.
Really good point, yeah.
And it's just going to be more of a frenzy in terms of everybody trying to compete for the same type of property.
Yeah, that's a good point. That's really good. Summary, guys, don't not do this. You know, do it yourself. You need to. We need to go through this process. If you need some help, then, you know, you still cannot, I guess, cut corners on any of this due diligence. We don't want the market to throw us around. There's always opportunity in property. We don't want to be, you know, paying for someone else's profits.